So today we're going to be talking about Silicon Valley Bank, or SVB. It's a really complicated topic, talking about fractional reserve banking, talking about interest rates and bonds. I'm breaking it down as simple as possible so that you guys can get the main idea of what went wrong at Silicon Valley Bank and how that can affect other banks nationally and internationally, as I'll get into later. But before we get to the video, please make sure to like, follow, subscribe, and to share the video. It really helps with growing the channel and also helps with the YouTube algorithm. With that, let's get to the video. So even though Silicon Valley Bank already failed, it's important to look at why it failed because it affects the entire banking industry. So the reason it failed was because of a bank run. All its customers wanted their money at the same exact moment, and Silicon Valley Bank couldn't pay that because they didn't have the cash. That's because of fractional reserve banking. The Federal Reserve states that a bank only needs to hold 10% of their depositors' deposit. Meaning, so if I were to go to a bank, I deposit $100, my bank can then loan out 90%, $90, or buy bonds with the other $90. That 90% is really for them to use as they see fit. The reason they do this is because they need to make money. That is how banks make money and how they pay interest on their accounts. Like when you deposit something in your account, you'll see that you get a certain percentage back in interest. The national average is 0.23%. It's nothing big, but it's still something that the bank has to pay you, and that's how they make money. They make money is through the fractional reserve banking system. How that relates to SVB is back in 2020, SVB's deposits tripled from around $50 billion to $100 billion, $180 billion. This is because of the clientele of the bank. It's in Silicon Valley, so its customers are tech startups or venture capital companies. A couple of them were Roku, Roblox, and Airbnb. So these companies have large fundraiser rounds. They fundraise a bunch of money, and they need to put the money in their cash accounts because they need to pay bills. These companies usually have high burn rates, meaning that they go through their money very quickly, so they're not going to go invest it in long term. They just need the cash on hand to pay their bills. So with 90% of $180 billion, you can do the math. SVB had all that money to work with. So what they decided to do was buy mortgage-backed securities and U.S. Treasuries, which are bonds. So how these work are mortgage-backed securities are backed by mortgages. Banks will group together mortgages and sell them. The movie The Big Short goes into really good detail and explains how mortgage-backed securities work and also how that played a part in the 2008 financial crash. U.S. Treasuries, on the other hand, is just you giving a loan to the government. You give them X amount, and they give you X amount in terms of an interest rate. So those are the two bonds that SVB bought. So before we move on, it's important to understand that interest rates and bonds have a relationship. It's an inverse relationship. So when the Fed started raising rates, interest rates, after lowering them all through COVID, that caused bonds to go down. When interest rates go up, bonds go down. When interest rates go down, bonds go up. So SVB didn't sell their bonds, the mortgage-backed securities and the U.S. Treasuries, when the Fed started raising rates. So they were holding on to their bonds as it was going lower and lower and lower. And also, these are long-term holds. So, they thought maybe rates would stay lower longer, but they didn't sell either way. So they had roughly $80 billion in just mortgage-backed securities. So they had a really big position in these bonds. So when people started to notice the problems at SVB with bond prices coming down, with interest rates going up, they decided to go to SVB and say, hey, we want our money now. SVB couldn't pay them because they didn't have the cash. Obviously, the 10%, they had 10% of their deposits, but they didn't have 100%. So they had to give them all their money. They had to sell a $20 billion portfolio at a $1.8 billion loss. They even tried selling more shares to try to raise the capital, but it was just too little too late. SVB was the largest, or the 18th largest bank in the nation, and the second largest bank failure in history of the United States. Signature Bank in New York City closed 2 days after Silicon Valley Bank closed, and Signature Bank was the third largest bank failure. Silvergate Bank soon closed following the two, and First Republic Bank has been looking rocky ever since. Two divisions left, one for Morgan Stanley and one for the Rockefeller Global Family Office. Over in Europe, Credit Suisse failed, or kind of didn't. It got bought out by UBS. But Credit Suisse had been looking rough for months. My Twitter feed is mostly Bitcoin, but there are people who were talking about Credit Suisse for months and how it was not looking great. And after SVB failed, Credit Suisse just took a plunge, and UBS bought Credit Suisse for around $3 billion, which is a lot, but when Credit Suisse was the second largest bank in Switzerland, it really is not a big number. And also, now that UBS owns Credit Suisse, people think that UBS is in a tough position. Credit default swaps on UBS, which are basically an asset of, if the bank fails or if X fails, you get paid. So if UBS fails, you get paid. Those credit default swaps skyrocketed after UBS bought Credit Suisse. So people think that UBS can fail. Also, Deutsche Bank has been struggling. So really, SVB failed, and it's like the dominoes keep falling, and the dust is kind of settling, but it's kind of a rocky past month in terms of the banking industry. So what happens now? Janet Yellen, who is the Secretary of the Treasury in the States, said that all depositors at Silicon Valley Bank will be made whole, so they won't lose any money. This kind of brings into question the FDIC, which is the Federal Deposit Insurance Corporation, which insures all deposits up to $250,000. So if you go to a bank and you put in an amount less than $250,000 and the bank fails, you're fine. The FDIC will pay out $250,000 to a max, and you'll be made whole. Now, the problem with Silicon Valley Bank was a lot of its customers, as I said, were large companies, so they had way more than $250,000 in their accounts. Only 2.7% of accounts at Silicon Valley Bank were insured. So people are now kind of suggesting that maybe the FDIC should insure every dollar in the U.S. banking system. But that's kind of not possible, because $17.6 trillion is the amount of money deposited in U.S. banks. And the FDIC only has $128 billion in its portfolio. And not all banks are as low as a percentage in terms of being insured as SVB, but it's not a really high number either. Wells Fargo is the most insured bank in the country, and they're only at 42% insured. So it's a really big question of, if we want to insure to infinity in terms of the FDIC, how are we going to pay for that? Are we just going to print the money? Are we going to tax people for the money? It's, in my opinion, kind of a silly plan. You're insuring the people, but you're really insuring the banks. The banks could do risky investments, but it's fine. People will get paid either way. But the kind of core of the problem with the FDIC, with fractional reserve banking, with bank runs, it all kind of comes to the point of, the book Creature from Jekyll Island makes this point of, banks bank on the assumption that not everyone is going to want their money at the same exact time. So they're really banking on there being no bank runs, which is kind of silly since there have been multiple bank runs in history, pre-Federal Reserve, post-Federal Reserve. It's just kind of something that happens with the market. If the market's kind of looking unstable, people want their money, and more people want their money until it's just a full-on bank run. So that is kind of the very quick summary of what happened with SVB. Things are looking kind of decent now. Everything's kind of settling. There's still some troubles with regional banks in the States, like with First Republic Bank, and in Europe there's Deutsche Bank, which is a very big bank in Germany, which kind of is looking in trouble. But that is the summary, and kind of the summary of also fractional reserve banking, which spawns a lot of problems in the banking industry.